STMicroelectronics just dropped a $3.49 billion Q2 2026 revenue print, beating their guidance midpoint by 110 basis points. Earnings per share came in at 31 cents non-GAAP and 24 cents GAAP.
Right.
That top line represents a 26% year-over-year jump and a 12.7% sequential increase from Q1.
Yeah, which is huge.
Exactly. And looking ahead, Q3 guidance is set at roughly $3.70 billion, and management is officially projecting Q4 to blow past the $4 billion mark.
Which, I mean, that completely defies traditional semiconductor seasonality.
Totally.
We're looking at a highly accelerated back half of the year that suggests, a fundamental shift in their order book rather than just normal cyclical demand.
Right. But here is the paradox we're unpacking today. If you are holding STM stock or just, tracking the semiconductor space in general, you have to square these numbers.
Right. It's confusing.
Yeah. How does a company beat its own guidance, project a record-breaking $4 billion Q4, and yet simultaneously take a $99 million operating loss in one of its core hardware segments?
It's a massive contradiction.
Yeah, exactly. So we are stepping in as your resident financial analyst today to tear down STM's Q2 earnings release and conference call.
Yeah, our goal is to extract exactly what you, the retail investor, really need to know about this 26% revenue jump.
We're bypassing all the fluff. We're going straight into the mechanics. Like, how are they expanding margins in a tough macro environment? Where are they actively bleeding cash?
Right.
And maybe most importantly, whether this highly aggressive AI and space guidance is actually grounded in booked reality.
Because it really is a textbook example of a legacy hardware giant undergoing a radical, highly capital-intensive internal pivot.
Yeah.
And they're doing all this while navigating a really choppy global economy. There's a deeply complex story hiding just beneath those headline figures.
For sure. So let's get right into the mechanics of the top line. We have the numbers out there, but we really need to understand the how.
Right.
Because if you look at the broader hardware landscape right now, it is undeniably tough. I mean, inflation is persistent, supply chain logistics are just squeezing hardware margins globally.
Oh, absolutely.
Yet, STM isn't just growing revenue, they're actually expanding their profitability. They posted a 35.2% non-GAAP gross margin, which is up 130 basis points year over year.
Yeah.
So with all these macro headwinds actively compressing margins across the sector, how exactly is STM squeezing an extra 130 basis points out of their operations?
Well, the margin expansion here is, it's purely a function of operational leverage and a strategic product mix.
Okay, break that down.
Yeah, so if we look at the commentary from management, there are really two primary drivers doing the heavy lifting here. First, they're experiencing significantly lower unused capacity charges.
Actually, I want to pause on that because unused capacity charges are kind of the silent killer in the semiconductor space.
Totally.
For those tracking the industry mechanics, a semiconductor fabrication plant, a fab, it basically operates like a commercial airline.
Right.
Like if an airline flies a plane half empty, they still have to pay for the plane, the crew, the fuel. The fixed costs just don't change. A fab is the same way. It's a multi-billion-dollar facility with staggering depreciation and maintenance costs. If it sits idle, it's essentially a giant furnace burning cash.
That is the perfect way to look at it. The fixed costs are absolute.
Yeah.
But if you're running your fabs at full capacity, utilization rates in the high 90s, those immense fixed costs are spread over a much larger volume of chips.
Right. The per unit cost drops.
Exactly. The cost to produce each individual chip drops precipitously, and your gross margins naturally expand. And right now, STM is running their facilities incredibly hot.
Wow.
But, utilization alone doesn't get you all the way to 35.2%.
So what's the second driver?
The second driver is a highly favorable product mix. They aren't just selling more chips in general. They're specifically selling more of their high-margin, high-complexity components.
And the end market demand metrics back that up completely. Like, let's look at communications equipment and computer peripherals, the CECP segment.
Right.
That specific segment is up an astonishing 50% year over year.
Which is wild. I mean, a 50% jump in a single year for a mature hardware segment is a total outlier event.
Yeah.
And it's not happening in a vacuum.
Yeah.
The industrial segment is also up 34% year over year.
So what does that actually tell us?
It tells us that the demand is really broad-based across their highest value end markets. Industrial and communications clients, they require specialized, rigorously tested chips, right?
Oh, right.
Which obviously command a significant premium over standard consumer electronics components.
And management actively signaled that supply is tightening across those exact categories. Like, they explicitly noted that inventory in the distribution channel is actually below their standard targets right now.
Yeah, and having distribution inventory fall below target while simultaneously posting a 26% revenue jump, that reveals a really crucial pricing dynamic.
Because they can't restock fast enough.
Exactly. It means products are flying off the shelves faster than STM can fill the channel. When demand outstrips supply at that distributor level, the manufacturer gains immense pricing power.
Right. No need to discount.
Exactly. They don't have to offer discounts to move volume. So you combine that pricing power with maximized fab utilization, and boom, you get that 130 basis point margin expansion.
Makes sense. But, a blended 26% revenue growth across the entire company is a great headline. But a blended number is essentially an average.
And averages can hide severe underlying problems.
Exactly. To understand the true structural health of STM, we have to look under the hood at the specific operating segments. And when you crack open this earnings report, it is truly a tale of two extremes.
Yeah, the aggregate numbers paint a picture of total dominance, but the segment breakdown reveals a company that is simultaneously thriving in next-generation technologies and undergoing severe, painful triage in its legacy divisions.
Let's break down the winners first, because the outsized growth in these three segments is carrying the financial weight of the entire company right now.
Oh, for sure. The clear standout is the Embedded Processing segment, or EMP. This division grew revenue by 35.5% year over year, hitting $1.14 billion for the quarter. But the metric that really matters is profitability. They posted a 19.7% operating margin. And management attributed this largely to just unprecedented strength in general-purpose microcontrollers.
Which makes perfect sense when you look at the macro trend of edge computing and the Internet of Things.
Right.
General-purpose microcontrollers are essentially the brains embedded in, smart appliances, factory automation robotics, medical devices.
Yeah.
As every single physical product becomes smart and connected, the demand for these microcontrollers scales exponentially.
Exactly. They're the foundational building blocks of the digitized physical world.
Okay, what else?
Then you have the RF Optical Communications segment, RFOC. They posted 32% year-over-year revenue growth, bringing in $445 million, and they achieved that with a staggering 21.2% operating margin.
Wow.
Yeah, and this is driven by the global build-out of high-speed telecom infrastructure.
Right, and we definitely cannot ignore analog MEMS and sensors, the AM&S segment. They are the largest single revenue contributor at $1.42 billion, which is up 26% year over year.
Yeah, that's massive.
And the report noted this was heavily aided by their imaging and MEMS products, alongside the really successful integration of the NXP MEMS sensor business they acquired.
Right, right.
Let's unpack the why here. MEMS stands for Microelectromechanical Systems. We are talking about microscopic moving parts etched directly onto a silicon chip.
Like in your phone.
Exactly. Things like accelerometers that tell your phone which way is up, or gyroscopes used in automotive safety systems.
And that NXP acquisition, that was a highly strategic chess move.
Mm-hmm.
By absorbing NXP's MEMS division, STM didn't just buy revenue, they bought critical intellectual property.
Right.
And they expanded their catalog for automotive and industrial clients. In the sensor market, clients want to buy integrated solutions from a single vendor. They don't want to piece together components from like 5 different suppliers.
Oh, that makes sense.
Yeah. Broadening that portfolio gives STM a distinct mechanical and commercial edge over competitors.
So, to visualize the structure of this company right now, imagine a high-speed bullet train.
Yep.
EMP, RFOC, and AM&S are 3 state-of-the-art locomotives pulling the company forward at just breakneck speed.
Yeah.
But they're dragging a derailed, rusting boxcar behind them.
That's a good way to put it.
That boxcar is the power and discrete segment, or P&D. The numbers here are just ugly.
They really are.
Revenue basically flatlined, eking out a miserable 3.7% year-over-year growth to $464 million. But the true shock is the profitability. Their operating margin cratered to a negative 21.4%.
Ouch.
Yeah, that translates to a $99 million operating loss for the quarter in this specific segment. Now, I have a theory here, but I want your take.
Sure.
In a booming semiconductor market where fab utilization is maxed out elsewhere, the only way you lose nearly $100 million in 3 months is if you are stuck paying the fixed costs on empty, outdated fabs.
Yep.
Is that what this $58 million restructuring charge in the footnotes is actually about?
You hit the nail on the head. That $58 million charge isn't some administrative reshuffle. It is the brutal cost of amputating obsolete manufacturing capacity.
Wow.
Yeah, management explicitly stated this charge reflects a company-wide program to, quote, reshape their manufacturing footprint and resize the global cost base.
And reshape the footprint is basically corporate speak for closing down old factories.
Precisely. Because the power and discrete segment, it deals with the components that manage raw electricity power conversion, voltage regulation.
Okay.
For decades, these were built on traditional silicon wafers in older fabs. But the entire industry, particularly the automotive and industrial sectors, they're rapidly migrating away from standard silicon,
Toward what?
moving toward wide bandgap materials like silicon carbide and gallium nitride. These new materials handle high voltages and extreme heat vastly better than traditional silicon, which is, critical for electric vehicles and renewable energy grids.
So STM has these legacy discrete fabs that produce components the modern market simply doesn't want anymore. The demand evaporated, the utilization rates in those specific older fabs plummeted,
Yeah.
but the fixed costs, the maintenance, the property taxes, the staff, all of that remained.
And that creates the negative 21% operating margin. So management is basically taking the pain now.
Right.
They're eating a $58 million restructuring hit to physically decommission those older facilities, write down the outdated equipment, and stop the cash bleed. They're cutting the dead weight while the other three segments are generating enough cash to subsidize the surgery.
Which brings us to how they are funding the future.
Yeah.
If they are actively tearing down the legacy power and discrete infrastructure, what are they building in its place? Let's unpack this highly aggressive Q4 guidance.
Okay, let's go.
STM expects Q4 revenues to exceed $4 billion, which is a nonlinear acceleration that just completely ignores normal seasonal trends.
It's a massive structural upgrade in their forward outlook.
Mm.
And the twin engines driving this, according to their presentation, are AI data centers and LEO low Earth orbit satellites.
Okay, those are two massive buzzwords.
They are, but management is officially raising their long-term ambitions here. For AI data centers, they expect over $1 billion in revenue for 2026, and they project well above $2 billion in 2027.
Wow.
And for LEO satellites, they estimate the total addressable market will hit roughly $3 billion by 2030, representing a four-fold increase from 2025.
Right.
And STM wants well above $3 billion in cumulative revenue from the LEO space just between 2026 and 2028.
All right, I have to play devil's advocate here.
Go for it.
We are operating in a market where every single company, from enterprise software to fast food chains, is slapping the word AI onto their earnings release to juice their valuation multiples.
Totally.
Targeting $2 billion in AI and multi-billions in space sounds fantastic, but talk is cheap. Are these booked revenues, or are they just waving flashy total addressable market projections at Wall Street?
It's definitely the right question to ask because the hype cycle is deafening right now.
Yep.
But if we look closely at the precise phrasing management used, they're being incredibly concrete.
Okay, how so?
They aren't just projecting theoretical future markets. They base that Q4 guidance on what they specifically term, quote, engaged customer programs and strong bookings.
Ah, so these are contracted, inked on paper sales.
Exactly. They stated, assuming the current dynamic continues and with the current engagements we have, well above $2 billion in 2027.
Got it.
That phrase, the current engagements we have, is the legal and financial bedrock of their projection. It means they've secured the design wins, they have the long-term supply agreements in hand,
Okay.
and we really have to understand what they're supplying. STM doesn't make the AI GPUs like NVIDIA or AMD, they make the critical infrastructure surrounding those GPUs.
Like the power management network.
Yes, an AI server rack consumes an astronomical amount of electricity. If you don't step down and manage that voltage with extreme precision, the rack literally melts.
Right, yeah.
STM is supplying the highly specialized power management, ICAs and optical transceivers required to keep these billion-dollar data centers functioning. The demand for those specific components is skyrocketing right alongside the GPUs.
And I guess the logic applies to the low Earth orbit satellite market as well. We are seeing a boom in mega constellations, basically thousands of satellites being launched to provide global broadband.
Yeah.
Traditionally, space-grade chips were bespoke, wildly expensive, and took years to develop because they had to survive radiation and extreme temperatures.
Exactly.
STM seems to have found a lucrative middle ground here. Commercial, off-the-shelf components that are modified and radiation-hardened just enough to survive in low Earth orbit for 5 to 7 years.
Right, and produced at a volume scale that makes these mega constellations economically viable.
Right, that is exactly their competitive moat in the ELEO space.
Yeah.
They are marrying high-volume commercial manufacturing with aerospace tolerances.
Yeah, but that brings us to the next structural hurdle. Chasing $2 billion AI targets and outfitting entire fleets of satellites, that requires intense capital expenditure.
It really does.
You need upfront investments in advanced R&D and completely retooled fabrication lines. So the question is, does STM actually have the war chest to fund this pivot, especially while they're spending cash to restructure their legacy segments?
Right, let's review the balance sheet.
Well, the short answer is their liquidity position is a fortress. They generated $502 million in net cash from operating activities just in this quarter alone.
Wow.
And they maintain a solid net financial position of $2.01 billion. When you aggregate their cash, short-term deposits, and marketable securities, their total liquidity sits comfortably over $6 billion.
Okay, stop right there because this is where I am legitimately confused and where a lot of retail investors are going to scratch their heads.
Okay, what is it?
If STM has $6 billion in total liquidity and they are printing $500 million in operating cash flow every single quarter, why on earth did they just issue a new $1.5 billion dual tranche senior unsecured convertible bond? Like, why dilute shareholders and take on $1.5 billion in new debt, split into 2031 and 2033 maturities when you are already swimming in cash?
It absolutely looks counterintuitive on the surface, but when you dig into the mechanics of corporate finance, this is a highly strategic maturity extension.
Explain that.
Simultaneously, with issuing that new $1.5 billion bond, STM announced the early redemption of a $750 million convertible bond that was due in 2027.
Oh, so they are swapping out near-term debt for long-term debt.
Precisely. Think about the timeline we just outlined for their AI and LEO catalysts. Those steep revenue ramps, the $2 billion AI target, the cumulative $3 billion LEO target, those require maximum execution and capital expenditure in 2026 and 2027.
Right.
If STM held onto their old debt,
Yeah.
they would have a $750 million bill coming due at the exact moment they need every available dollar to build out AI manufacturing capacity.
Oh, I see the logic in clearing the runway. You don't want to be forced to drain your operating cash, or worse, try to refinance in a potentially hostile interest rate environment in 2027.
Yeah.
But you are still trading older, likely cheaper debt for new debt that extends into the 2030s. I mean, it is a steep price to pay for peace of mind.
It is a premium, certainly, but it guarantees they have unimpeded financial flexibility to pour capital into fabs and R&D precisely when the AI market demands it. They're basically removing refinancing risk from the board during their most critical execution window.
Fair enough. But we can't just paint a perfect picture of structural upgrades and AI growth here.
No, definitely not.
We have to outline the notable risks because executing a manufacturing pivot of this scale is fraught with potential pitfalls.
Absolutely. And there are several severe risk factors explicitly called out in the release. First is the execution risk tied to that $58 million restructuring charge in Power and Discrete.
Right, closing the fabs.
Yeah, decommissioning fabs and shifting supply chains is incredibly complex. If they fail to resize that cost base efficiently, the P&D segment will continue to drag down overall operating margins.
Acting as a permanent anchor on the company's profitability, regardless of how well the AI division performs. What about macro risks? Because the semiconductor industry is kind of the ultimate proxy for geopolitical tension right now.
Yeah, and management included highly relevant forward-looking warnings about macroeconomic uncertainties, specifically calling out the potential expansion of global trade tariffs.
Okay.
STM relies on a highly globalized supply chain, raw materials from one continent, fabrication in another, packaging in a third.
Right.
Sudden retaliatory tariff shifts can instantly compress gross margins by increasing the cost of goods sold literally overnight.
Wow. Okay. And finally, there is a very specific near-term risk to watch for Q3. Management explicitly warned that their personal electronics segment is expected to see below normal seasonality.
Yeah, and that is a crucial caveat. It means demand for standard consumer gadgets, smartphones, wearables, tablets, is tracking softer than usual.
Right.
It serves as a stark reminder that while the AI and space narratives are dominating the headlines, STM still has heavy exposure to the fickle, cyclical whims of the everyday consumer electronics cycle.
All right, let's synthesize this down. Rapid fire summary of STM's Q2 2026. The company posted a strong top and bottom line beat, driven by heavy demand in their communications equipment and industrial segments.
Sure.
Gross margins expanded to 35.2% due to maximized fab utilization and a highly favorable pricing environment.
Right, and we have a clear divergence in operational health.
Yeah.
Embedded processing and RF optical communications are generating outsized growth and near 20% operating margins, while the legacy power and discrete segment is actively bleeding cash.
Which is forcing a major internal restructuring and the physical closure of obsolete manufacturing footprint.
Exactly.
But the core narrative, the catalyst driving that aggressive Q4 guidance of above $4 billion is their pivot toward AI data centers and LEO satellites.
Yeah.
They have the physical bookings in hand, they have proactively restructured their debt to fund the capital expenditures, and they are targeting multi-billion-dollar revenues in these next-generation sectors over the next 24 months.
It's the anatomy of a hardware company aggressively shedding its past to finance its future.
Which leaves us with a broader question to ponder as we wrap up today's deep dive. If STM seamlessly executes this pivot and easily hits its target of over $2 billion in AI data center revenue by 2027,
Right.
and we see similar aggressive pivots from their Tier 1 competitors, how much of the broader semiconductor market share will permanently consolidate around the companies fueling the AI infrastructure boom?
That's the billion-dollar question.
Exactly. Will legacy product lines like STM's bleeding power and discrete segment ultimately become stranded assets across the entire industry, forcing an unprecedented wave of multi-billion-dollar write-downs and fab closures for anyone left holding old technology?
That really is the defining structural question for the entire hardware sector right now.
Well, if you want to stay ahead of the curve and unpack these dynamics as they happen, make sure you follow the show for our daily earnings coverage. See you on the next deep dive.